Hey everyone, welcome back to another episode of the Beyond MD podcast. I'm really excited for this one because we dive into my favorite topic, which is the craft of investing. And today we focus on microcap stocks. These are really small companies, typically under a market capitalization of $300 million. There's not going to be a lot of institutional buying here. These companies often lack analyst coverage. And to guide us through this stock universe, I am joined by Mathieu Martin, who oversees the MicroCap fund at Rivemont in Quebec. And he is also the author of the Stocks and Stones newsletter, which is a wonderful resource. Mathieu is a wonderful educator and a passionate investor, and he talks about why microcaps. He goes through his investing journey and discusses his entire process, the screening, the research, the key investing pillars. He goes over his best and worst investments and the lessons that he's learned. And then we dive into 7 individual microcap stocks, and Mathieu goes over some of his highest conviction ideas. I got so much out of this interview. I learned a lot, and I hope you do as well. Hey, Mathieu, welcome to the podcast. I'm really excited to have you here today because it was at the Toronto MicroCap conference last October where I heard you speak and you made a stock pitch. It's going to be a name that we will talk about later today, but really excited to host you and pick your brain. And thank you again for making time for me and my audience, and welcome to the show.
Thanks for having me, Atin.
Yeah. So let's dive right into it. Mathieu, I think people would find it interesting first to understand your investing journey and how you came to arrive at microcap stocks as your main focus.
Yeah, for sure. So, my background is atypical. I would say, I started in working in the family business, but both my parents were entrepreneurs, like small businesses. And I started working for my father's business in the healthcare space, actually. We were selling, healthcare products for disabled people. So like electric hospital beds and, like wheelchairs, that kind of stuff. So I started working there when I was a teenager. So I did, delivery, I did sales, eventually my father opened a new store and I was kind of the store manager there. But like very small store, I was the only employee basically. So I learned a bit about, business that way, but I would say it almost taught me more about what not to do. Or maybe what kind of business model is more challenging, I guess, because the business at some point, struggled a little bit. We had some challenges. So, eventually I started exploring other things. I wanted to strike it on my own and do my own thing. So I started experimenting a bit with different ideas and I stumbled upon poker. Yeah. So I started playing poker. I started just learning about the game by reading books and, just chatting on message boards with other players, things like that. And then, I was lucky enough to win some money playing poker over the next several years. And I took my poker winnings and put them in the stock market. So that was kind of the next idea for me was the pivot to microcap investing. So that's how I got, maybe I can stop there, but that's how I got into microcaps.
Mathieu, it's interesting because you're not the first successful investor who has a poker background. I'm just very curious, what are the lessons that you learned in poker that translate to investing?
Yeah, well, there are a lot of similarities actually, because in poker, like in investing, you operate in an environment that's uncertain. You operate with incomplete information and you have to make probability weighted decisions and you live with the outcome. Sometimes you're lucky, sometimes you're unlucky. So it taught me how to manage risk. In poker, it's your bankroll. You don't want to bet everything you have on one game or one end. You want to manage your bankroll carefully. In the stock market, it's the same with position sizing. And then you have to manage your emotions, when things don't go your way. Like sometimes in poker, you make the right decisions. Like every end, you feel like you've made the right decision, but the cards go against you for a day or a week or a month. And if you lose your cool and you start making irrational decisions, things can spiral out of control. So in the stock market, it's the same. Sometimes your stocks or your strategy is out of favor, or volatility, doesn't go your way for some time. And if you start making bad decisions because of that, you're going to worsen the situation. So I think managing your emotion, the mental aspect of it is very crucial, especially in microcaps.
I think those are great points. And Mathieu, why did you decide to make microcaps your main focus?
Well, actually, it's another parallel with poker because, in poker, you play against the other opponents at the table. So if you're able to make better decisions than the other players, you should be able to win, let's say, over a large sample of hands. If you consistently make better decisions, you should win over the long term. And so the goal is to play against weaker opponents. People make a lot of mistakes. That's how you improve your odds of winning, essentially. So I took that concept and I said, okay, in the stock market, where is competition the weakest? Where do people make mistakes? Where is the market the least efficient? And I thought microcaps seemed like a pretty good place to start for an amateur like me, because it's mostly, part-time investors, like the very sophisticated investors or the large funds, the large institutional investors. They don't play in microcaps because they can't deploy enough capital there. The liquidity is too low. So I thought, less competition sounds perfect for me. So that's what I decided to try initially, and it worked out pretty well.
So Mathieu, you're the portfolio manager for the Rivemont MicroCap Fund. And tell us a little bit about this fund. How long has it been around for? How many positions do you hold? And only if you feel comfortable, maybe elaborate on some of the returns of the fund as well.
Yeah, sure. So when I transitioned when I started investing in microcaps with my own capital, it was in 2014. So I did that for about 4 years, just investing my personal money, and I compounded my TFSA at 40% CAGR, so 40% per year for the first 4 years.
Wow!
And yeah, those were pretty good years. I made some
what years? What years were those? I'm just curious. When did you start doing
2014 to 2018.
Okay.
And then, I started a blog back then with one of my friends, and we were sharing our investment ideas and we were sharing educational content to get our name out there, basically. And we started building a community of like-minded investors. And then, after a few years, people started to approach us asking if we could manage money or if they could participate in our strategy. So at that point, we decided, okay, let's start a microcap fund. So we partnered with an existing asset management firm called Rivemont, a firm that was started in Gatineau, Quebec. And it was a small firm that was growing, and they were focused on alternative strategies. So they saw the microcap strategy as an interesting strategy that they could offer to their clients and help them grow the assets under management. So we started like that with Rivemont with about 5 million in assets under management in the microcap fund in 2018. And it grew from there. Today, it's almost 16 million. So, the returns have been approximately, you can look on our website, Rivemont.ca, if you want the exact details, but it's about 11.5% per year for the last 8 years. That's net of all the fees. So that's a net return to investors. And, I would say in general, like those haven't been great years for the small microcap asset class in general. Like, it's no secret that large caps have outperformed for quite some time now. So, I think my aim initially, but it's still my aim actually to generate higher returns than that over the long term. But, it's been, the environment has been a bit challenging for small caps. So, I'm pleased with the performance so far, but I think I could do better in the future.
And maybe how many positions do you hold in your portfolio? And I guess what I'm trying to get at here is how many microcap companies, let's say in Canada, are there, microcap or very, very small cap? And how many of those do you typically invest in?
Yeah, so it's a very large universe. So if you just look, Canadian microcaps defined as companies with a market cap below 300 million. There are about 2,800 companies in Canada only. So it's a very vast universe. Then if you narrow it down a little bit, like my focus is typically on non-natural resource companies. I'll look at some of the maybe producers that are profitable, but for the most part, I avoid anything that's like exploration or, mining or oil and gas exploration, for example. So I can remove about 2/3 of the market if you remove natural resources. So you're left with about, call it 1,000 companies that would be in my investable universe. And then if you narrow it down further, you remove anything that's what I consider very speculative, pre-revenue opportunities, biotechs and like early stage tech companies, things like that. You narrow it down even more. So you're left with maybe a couple hundred companies that I'll look at seriously, if you will. And then the goal is to build a portfolio of about 15 to 20 stocks that are essentially my highest conviction ideas in that whole universe. So it's a long process to really find the needle in the haystack, the great high quality companies that will grow and become small caps or mid caps eventually.
Maybe you can start now by outlining the key pillars of your investing process, and then we can pick away at some of this.
Yeah, sure. So, there are essentially 3 big things that I look at when I look at a new investment opportunity. So the first one is the business quality. Then you have the management team, and then you have the valuation. So, business, and in that order, by the way, of importance. So first of all, I want to find a quality business with a moat. Just goes back to my point actually on what I learned to avoid. And I learned that in the stock market as well by investing in businesses that were commoditized or didn't have anything proprietary or unique. And these businesses can generate strong growth and strong profits for some period of time, but eventually competition comes in and their profits get competed away. So I want a company with a durable growth opportunity and they are protected in some ways. And it's actually really hard to find that in microcaps because, those are small businesses and, you won't find a company with a network effect like a Meta, for example. You won't find that in microcaps. So you have to find an emerging moat. Maybe they dominate a specific niche and hopefully they can grow that niche or expand into adjacent niches over time. So that's the first aspect. Then you have the management team. So I want to invest with somebody that is honest, that I can trust, that is not promotional, that has a track record, ideally. If they've grown and sold another business in the past, that's definitely something I look at. I almost always talk to the management team before investing. I want to assess, their capital allocation skills. Do they think long-term or short-term? Those types of things. And then the last one is the valuation. Am I paying the right price for this business? And the reason why I put valuation third is because in my early days, I would look at price first and I would buy low quality businesses with questionable management teams just because they were cheap. And that doesn't tend to work very well. So for me, I just want to find the right ingredients, good management, good business. And then sometimes I wait years before the price is right for me to buy.
Interesting. So when it comes to the management team, how important is it to you also to look for companies that are founder-led with high insider ownership? Are those important metrics?
Yes, it is. I mean, it's not mandatory, but it's something I like to see. Anything that provides me with the comfort that my interests as a minority shareholders are aligned with the management team is something I like to see for sure, but I've invested and I've had success with companies that are not founder-led. So, it's a nice to have. It's not a must-have.
Okay. Mathieu, you mentioned there are several hundred companies that could fit your investing mold. My first question is, what are the processes you have in place to screen for opportunities? Because I imagine to do this well, it can take a lot of time. So how do you go about screening through all these opportunities?
Yes, it is time consuming for sure. One of the things I started doing a few years ago, which is relatively unique, I don't think a lot of people do that, is I skim through all the public filings on the Canadian market every single day. So I'm talking press releases, financial statements. Every morning I log into Stockwatch and I pull up the previous day's filings, like every press release or financial statement that was filed by a public Canadian company. So it's anywhere from 200 to 1,000 new filings per day. And I skim through the headlines. So, I discard, again, like anything that's natural resources, like natural resource exploration. I don't read those press releases. But if I see something that piques my interest, like a headline that, I haven't looked at this company before, or maybe it looks like a significant piece of news, I'm going to open it and read the press release. Or I'm going to look at the financial statements. And what I'm looking for are inflection points. Maybe a company that, was pre-revenue that starts to generate revenue, or maybe the company that was unprofitable becomes profitable for the first time. It could be a new order, like they announce a significant new client. It could be a change in management team. So there are all sorts of things that can signal that a business is changing. And then if I feel like something is changing, but the market hasn't picked up on that change yet, that can be an opportunity.
So that right off the bat, that's a lot of work and a lot of time spent. I'm very curious what time you start your days, Mathieu, if you're reading all the press releases, and how much time does that process take?
Yeah, well, I wake up pretty early. So I have 2 young kids, and I typically wake up at 5 a.m. and I start working before they wake up.
Yeah.
So the day starts early, but I would say it takes about 30 to 60 minutes per day now, because I know a lot of these companies already. So the filtering is much quicker, because I've seen all those names over and over and over, so I can discard very quickly what I don't want to read. But if someone were to start from scratch with no prior knowledge, it would probably take a few hours per day to screen all of that.
Okay. You mentioned that you will typically speak to the companies that you decide to invest in. You spend a lot of time reading press releases, financial statements, and then how else do you round out your research? Do you talk to a lot of other investors who can maybe share some useful insights? Maybe touch on the rest of your research process.
Yeah. So that what I just explained is the screening part. So it's really the top of the funnel. And when I find something that looks attractive, then I'm gonna put it in my research process. And the research process is really, the goal ultimately is to know the company better than most other investors out there. So I'm not pretending I'm going to be the ultimate expert on every company, but I want to know it better than 90% of people. So the way I do that, I obviously, I do a lot of research from what I can find publicly. I'm going to, look at the financial statements, MD&As, the investor presentation on the website. I'm going to read if there are any write-ups out there by other investors. Then I'm going to speak with the management team. I'm going to, if I can, if it's practical, I'm going to go visit them in person. I'm going to visit the headquarters, the manufacturing facility. I'm going to try the products or services. So I really try to go deep. And I'm obviously, I'm not doing this with every company I research, because that's a very long process. So I do this over time. And that if I can speak maybe a little bit about timeline, when I start looking at an opportunity and when I ultimately invest, it can be a multi-year process in some cases. There are companies like that I visited in person, and I've done a lot of research 5 years ago, and I've been following them ever since. And then the inflection point happens. But when the inflection point happens, my research is done. I have 5 years of history of, the financial model is done. I have multiple calls with management. So I'm ready to act right away. I can be one of the first people to identify that inflection point and buy the stock. So that's where the moat, I think, is for my process.
Okay, that's fascinating. Now, speaking of that inflection point, do you ever invest in companies that are not yet profitable, but maybe things are pointing to one day profitability being reached?
Rarely, I would say.
Yeah.
The only instance where I would invest in a non-profitable company is software companies, for example, software as a service companies. And even these days, it's with AI, it's a bit more challenging to underwrite those businesses. But, a company that has recurring revenues that are very sticky, with a high retention rate, and it's fairly predictable. If they spend on sales and marketing to grow faster, but they could scale back and become profitable if they wanted to, those types of opportunities I will consider, and I have invested in those types of setups before. But let's say a manufacturing company that has not reached scale yet, and they really need to grow to become profitable, otherwise they won't be. I think that's generally too risky for me, because there are so many stories like that in microcaps where the company experiences some delays, or they can't grow fast enough, and then they have to dilute, they have to issue new shares, dilute the existing shareholders, and then it spirals down, and all the returns are lost through dilution. So yeah, it's tough.
Now, I don't necessarily want to open up a new can of worms by discussing software, but in one of your recent presentations, I believe you made a comment on you do tend to like companies that are focused on perhaps businesses related to the older economy rather than necessarily asset-light companies. And it's interesting because I think in the last 5 years, a lot of us were looking at companies that are asset-light as being a good thing. And now there's perhaps a little bit of unpredictability related to that. And when I look at my own portfolio, I'm drawn to both, but there's certainly some old economy businesses like waste management, like railways that I have been drawn to for a long, long time. And where do you fall on that spectrum today? Old economy businesses versus software. I would love your take.
Yeah, well, it's interesting because over the last 5 years, people have put the software companies on a pedestal. They were considered the highest quality companies you could imagine, with growth, sticky revenues that are, predictable and all that stuff. And then AI arrived. And now it seems like at least some software businesses will be disrupted and their revenues and profits will be competed away. So now it's less clear, which software companies still deserve high valuations and which ones don't. And then if you start from that baseline where, AI might disrupt intangible asset-based businesses. Then you look at companies that require physical assets, physical, manufacturing facilities, that kind of stuff, trucks and, planes and whatever. Those businesses won't get disrupted by AI.
Yeah, totally.
So I think that's why we've seen a shift towards, those types of hard asset businesses. And I think it makes sense. And, these businesses were considered for the most part low quality, boring businesses. Their valuations were super low, and this still are for the most part. So I think that rotation makes perfect sense to me. And then if you look at the macro picture, software has benefited from, decades of declining interest rates. Money was freely available, fund unprofitable growth for some of these businesses, and now it's been reversing a little bit. So the cost of capital has increased a little bit since 2022. So that plays a part in that as well.
So is it safe to say that in today's environment, you are gravitating a little bit more towards businesses tied to the older economy?
Yeah, for the most part, yes. Yeah. I mean, it's still a mix. I still own some software businesses in the portfolio. It's a much smaller allocation than it used to be. Okay. Like at some point, if you look back at my portfolio, maybe 5 years ago, you would have seen maybe a 50% allocation to technology in the portfolio. Okay. Today, it's, D-Box is included in our tech allocation, but it isn't really a software company. But if you look pure software, it's less than 10%.
Okay.
Of the portfolio today. So yeah, it's been a big shift.
Okay, we will talk about D-Box later on. Last question on your process is you wrote an interesting article on your blog, Stocks and Stones, and I think it was focused on deciding when to sell a losing position. And here's what I've learned over time, Mathieu, is that myself and other investors, sometimes there can be a tendency to see very rapid gains in a great company in 4 to 5 years, and then all of a sudden we start pulling flowers from our garden. Whereas when we have a weed in the garden, a losing position, somehow there's a bit of a sunk cost fallacy. Sometimes we get emotionally attached. Sometimes we don't want to believe that we are wrong. But in my experience, and I have a few in my portfolio too, I wish I trimmed these weeds a little bit earlier. So my question to you is how do you decide when is it time to let go of a position that maybe isn't working out as planned?
It's a great question and something that I've been working on in my own process for the last several years. And I there's still room for improvement, but I think I've been improving a little bit in that area. And, one thing I do when I enter a position from the get-go, I write down, what is my investment thesis? Just like a summary, a few lines. What is my positive investment thesis? And then what would break my thesis? So I call it kill criteria. What would kill my thesis? So if and you need to be precise with that. So, if we reach this specific state of things by this date, then my thesis is no longer valid. So, if revenues haven't grown at least 10% by the end of this fiscal year, and let's say my thesis was, I expect 20% growth. Okay. If it's below 10% by this date, then my thesis is clearly broken. So that's my kill criterion. And I'll write down a few of those, like what are the KPIs that I monitor. And then every quarter I reassess and I benchmark based on these kill criteria. And it doesn't necessarily mean that if one criterion is triggered, I will immediately sell, but at least it prompts me to reassess and question myself and, think back to what was my initial thesis. Now I know it's wrong. What should I do? And likely I should probably sell. So that's just like a reminder and a process to understand, when clearly you've been proven wrong and when you should move on. And when you do it that way, sometimes you'll have to sell with a 20%, 30% loss or something, but it makes you avoid the situations that spiral down where you end up losing 70, 80, 90% of your money on a stock.
Okay. And I want to ask you about valuation, but I thought it might be more appropriate to ask you with our specific stock discussion. So I can save that one for later. Mathieu, maybe we can take some of these principles and just put them into action. Perhaps can you share with us your most successful investment? And then maybe just to balance that with an investment that didn't work out as planned and maybe what you learned from each scenario.
Yeah, absolutely. So the best investment I've made so far with the fund is a company called Kraken Robotics. The ticker is PNG on the TSX Venture. So this company, I made about close to 60 times my money on the initial shares that I bought in 2018 up until earlier this year. And we still own it in the portfolio, very small position, but just for full disclosure. So the company is, they manufacture sonars and batteries that go onto underwater drones. So this is used for, there are some commercial uses, for example, inspecting offshore wind farms, infrastructure behind the water, under the water. And it's also used in military applications for mine hunting. So, this company, I founded in 2017, 2018. I met the founder at a conference. I was very impressed by the team. So management team to me was a big check mark. I was very impressed with the team. I thought the product was really cool as well. I saw how it could grow, like it had a long growth runway. It was a small company, 3.5 million in revenue back then. But I wasn't sure about the business quality, essentially. Yes, sounds like a good product. They have sales. The sales are growing, but they were still unprofitable. It lacked a little bit of validation. So in early 2018, one of the company's largest customers decided to take a stake in the company. They bought, I think it was a 20% stake in the company at a premium to the prevailing share price. So they invested at a 30% premium to the share price. They bought 20% of the business. So I was like, okay, now that's the validation I was waiting for, because the customer likes the product enough that they're willing to buy a piece of the business. That's how much they believe in the long-term potential of these products. So that's when we started increasing our position in Kraken. And then, the rest is history. I mean, the company just executed perfectly. They grew, if you fast forward 5-6 years later, they grew revenue, I think almost 50% per year for the next 5 years. They became profitable, very profitable. And now today it's a company. They just made a big acquisition. They're going to be a $300 to $400 million revenue company that's, LTD profitable. And they have, hundreds of millions of dollars on the balance sheet. So it's been a wild ride, but one of the lessons for me that I think is applicable to other stocks is really like the discovery process that Kraken went through. It started as a $20 million market cap company and became a multi-billion-dollar company today. And, initially when you're a $20 million company, you're traded mostly by, retail investors, like very small investors. You're unknown. You have no analyst coverage, no institutional ownership. And then as you grow, the process is typically like smart retail investors own it. Then the small funds get involved, and then the bigger funds get involved. And then retail comes back at the end, like recently, if you look the last 6 to 12 months, it's been heavily promoted by retail investors on YouTube, social media.
All the time.
Yeah, exactly. Yep. So that's what I call, dumb retail, if you will, like people who just buy on, momentum and a story, and they don't do their research properly. So that's kind of the whole discovery process that a stock will go through. And if you ride that wave, it's a very, very powerful wave.
My question is on that discovery process. When is that transition point typically where investments into the company go from just retail to funds? Is it around the $100 million mark?
Yeah, you start to see it at $100 million. Maybe they get one or two analysts that start covering the company, and you get some small funds that start to look at it. But every new threshold you reach, like 200 million, 300, 500, $1 billion in market cap, you unlock new pools of capital because every fund has some threshold or limitations that they won't go below. So as the liquidity improves, the share price increases, you get new pools of capital that can buy it, which fuels, further share price appreciation and more liquidity.
Yeah. And I noticed Kraken, I just checked the ticker. I think it's in a bit of a correction, 25-30%. Do you still own it in the portfolio? And do you view this as a meaningful pullback given the health of the business?
Yes. Well, I mean, the stock is expensive for sure, especially as it got to $10 a share. It became very expensive. So I think it's totally normal that it had the pullback that it had. For me, like this thesis has largely played out, I would say. I sold most of my position on the way up. I sold as high as $10 a share. And right now it's a very small, it's probably one of my smallest holdings right now in the portfolio. The reason I still hold it is because, it's been such a great success for me. I still think it's a very high quality business. I still very much like the management team, but the valuation is not there for me right now. So, but that's my third criteria, if you remember, like in the order of importance, that's the third. So I don't sell just based on valuation, but I wouldn't add here. So I'm just holding.
Yeah, fair enough. Okay, before the individual stocks that we're going to discuss, what about an investment that was not successful and that did not work out as planned?
Yeah, so actually I have a couple of them that I can quickly walk you through. The first one is called Microbix Biosystems, MBX on the TSX. So this is actually a healthcare company. They manufacture antigens that go into diagnostic tests. And it's a business that's been around for, call it 30 years, growing, 5-10% a year, kind of, boring kind of manufacturing business, if you will, in the healthcare space. And a new CEO came on board several years ago, and he decided, we need to grow this business. We need to leverage the expertise that we have to develop new product lines. And so he started developing a new product line called quality assurance products. So essentially, like if you run a diagnostic test and you want to make sure that your instrument is well calibrated, it's the best practice is to use a quality control. Like every 30 tests or 50 tests, you run a known positive and known negative sample in the instrument and make sure it spits out the right result. So they started developing this new product line And they had some very high expectations about the growth potential there. They shared multiple times that they could grow the business from, $10 million in revenue, like their legacy business, to over $100 million in revenue with this new quality assurance product line. And, I drank the Kool-Aid, essentially. I would say, I got very excited about the potential. They got some early traction. They announced some customers, but, sales never really ramped up. Like, it was for the most part a good story that wasn't yet backed by real financial results. And I scaled up my position too quickly, believing that, the thesis would play out. But I didn't have enough validation that the thesis would play out. So essentially, the thesis did not play out, and they weren't. So far, never say never, but so far they haven't grown revenue to the extent that they thought they would and that I thought they would. So lost a lot of money on that one because the position sizing was wrong. I should have kept it small. The other example I can give you is actually not a stock that I lost money on, but it was a big opportunity cost. It's a company called Accru, AKR. It's not public anymore. Actually, it has been privatized last year.
Okay.
So it's a small software as a service company. They do the backend software for gift card and loyalty programs. So if you go like your local coffee shop and you have your loyalty card, you swipe it in the terminal. The backend system that handles the points, the rewards, that could be Accru, for example. There are many providers of those kinds of solutions. So Accru decided to roll up the sector, buy up all these small providers that were, for the most part, unprofitable, struggling, near bankruptcy. And their model was to buy a small asset with maybe $1 million or $2 million in revenue, migrate all the customers to their platform, shut down the old platform, remove all the costs, fire all the employees, and the profitability on these acquired revenues, ultimately when it was integrated, was really high. But the challenge with a model like that, if you're a microcap company, like it was a $10 million market cap, your stock is illiquid. You can't raise capital. You don't have any analyst coverage. You don't have any investment banks that will back the company. You have no sophisticated investors in the stock. So you're trying to make all these acquisitions, but you have no access to capital. Your stock price is trading at a low valuation, so it's not attractive to pay with shares. So the CEO always had to find these creative deals where, he would finance it with earnouts and deferred payments and all that stuff. He had access to some debt, but then at some point you max out the debt capacity. So you have to wait, a year to repay the debt before you can do more acquisitions. So it was just like a really, really slow and painful process to grow this business. And again, position sizing mistake. I made it a way too large position in the portfolio. And I ended up, we sold the business last year. I made a profit on the investment, a small profit, but the compound growth of the investment since 2018 has been terrible. If you look at it per year. So, it taught me that, executing a roll-up strategy in microcaps, super, super, super challenging. I've seen very few examples of companies that have succeeded. So I kind of stay away from that now.
This episode is brought to you by Clever Consult. To my fellow medical specialists, you need more than just an AI scribe. Imagine walking into a patient's room where 80% of your clinical note is already completed before you even begin. Canadian gastroenterologist Dr. Kyle Fertinsky found that even with the latest tools, he was still buried in repetitive, low-level tasks. So, he created Clever Consult, the first and only AI platform built exclusively for specialists. Clever Consult has the best-in-class document reviewer built for your specialty. They even have a customizable questionnaire where patient responses can integrate directly into your clinical note. Plus, it comes with the first-ever specialty-trained AI scribe. Clever Consult is 100% Canadian and fully compliant with all privacy standards. Join hundreds of specialists already saving more than 5 hours a week using Clever Consult. To get your 14-day trial started, visit cleverconsult.ai and tell them the Beyond MD podcast sent you. That is helpful because I think there's just as much, if not more, to learn from the investments that don't work out compared to the ones that do. Mathieu, let's move on to some of the specific stocks that we're going to discuss today. And we'll start with some of the, I guess, technology names. Maybe let's just start with D-Box. Ticker is DBO. I believe the market cap of the company is around 260 million, and they commercialize haptic motion systems. I know you've talked about owning this one. And from my understanding, it was perhaps one of the biggest winners for you guys in 2025, but just tell us about the company and what you think about it.
Yeah, absolutely. It's been a big winner so far. I still think there's a lot of upside on this one. So it's still today it's my largest position in the fund, my highest conviction idea. So like you said, the company sells motion seats for cinemas. So if you go into a cinema, you buy a D-Box ticket, you sit in that seat that will move and vibrate according to what's happening on the screen in the movie. So it's a premium experience when you go to see a movie at the cinema. And the industry has been moving and leaning actually very heavily into premium offerings over the last 5 to 10 years. So your premium offerings can be like an IMAX, for example, like the big screens. It can be a 4DX, which is a bit similar to D-Box, but they have more effects like water will get splashed in your face and wind and all that stuff. So I haven't tried it because it's not widely available in Canada, but those are there are a few different types of offerings in the premium space. And, cinema operators have realized that in the age of streaming, it's so easy to watch a movie at home on your couch. If you're going to go out, watch a movie at the cinema, you need to have something special. You want to experience something different that you won't get at home. So the people who go out now, they tend to buy more of these premium experiences, and they tend to spend more on food and beverage as well. So that's how the cinema industry is trying to, generate more profits. And so D-Box plays exactly into that trend. And they've been gaining a lot of traction lately, especially with their largest customer, which is Cinemark in the US. Cinemark is the third largest exhibitor in the North American market. So they've been deploying a lot of D-Box seats. And the business model is very interesting. So D-Box will sell the seats. So there's a hardware sale initially. And it's sold, at a profit for D-Box. And then the seats get installed, and D-Box will get a royalty on every ticket sold. So every time you buy a D-Box ticket, it's an $8 upcharge on your regular ticket price. D-Box will get, call it 20 to 25% of that upcharge in the form of a royalty. So the model is very simple. You deploy more seats in the market, and then you hopefully sell more of these tickets that generate royalties over time. And, they've been executing this plan really well since call it last year when the new management team came in. They've been growing revenues, growing royalties, growing profits. So it's been great so far.
How much of D-Box's revenue is tied to cinemas? I assume they probably have a few other vectors, but what percentage goes to cinemas?
The exact percentage I don't recall, but it's the majority. The majority of revenues is tied to cinemas, but they are also active in simulation and training and sim racing. So like if you think about like your sim racing rig that you could play with at home or in some venues like F1 Arcade, and simulation and training is more like training simulators for every machinery. So they are active in those verticals, but these are just hardware sales. You sell the actuator, the hardware that makes the seat move. And then you don't get any royalties. So that's less attractive, I would say.
I guess my only question about this one that, when I go out to the cinema with my family, I find the costs add up really fast. We're buying popcorn, we're buying candies, and quickly, a movie outing for a family of 4 like us becomes $100 easily. Do you get concerned at all about pricing power and just the consumer being able to continue to expend on these experiences going forward?
Yeah, well, I mean, it's certainly one of the main risks, the health of the consumer. But, like people go go less to the cinema now, but when they do, they make it a special occasion and they spend more per outing. So I don't think, so far it hasn't been an issue. And the other thing to consider, I'm not sure if you're familiar with the concept of the K-shaped economy.
Oh yeah, for sure. That's yeah.
So it's basically like some people, like right now in our economy, some people are doing really well. Some people are doing very poorly. There's like the middle class is getting pushed in one or the other direction. So I think people that are doing well are still spending on these premium experiences, and they're spending actually a lot. Like premium offerings are growing in many other industries. You look at airlines, you look at beauty products, you look at consumer electronics, it's growing in all other areas as well. So I'm not concerned at this point, but, things can change.
And just to solidify the investment thesis, Mathieu, in terms of how many cinemas D-Box has penetrated with their product, is there still a long way to go? Like, is there still a very large total addressable market for this company?
Yeah, very much. Actually, so today they are in about 1,200 screens.
Mm-hmm.
Worldwide. The total addressable market is 200,000 screens worldwide.
Wow. Okay.
42,000 in North America alone.
Wow.
So they are less than 1% market share right now.
Okay, that's very interesting to me. And I know the stock has run up quite a bit in the last 12 months. How do you value a company like this? What metrics are you looking at?
Typically, multiple of free cash flow is what I look at. So every company is different.
Mm-hmm.
Typically, it's some form of free cash flow. Like I make my own adjustments based on the business. If they have some capex requirements or if they have some special, expenses in a year, I'll adjust things in and out. But for the most part, free cash flow multiple. So I bought D-Box. It was probably trading on a 7-8 times free cash flow multiple for a company that's growing royalties 20% plus per year. It was very, very cheap and misunderstood back then, talking a year ago. Now you're probably looking at 14, 15 times free cash flow multiple, which is still reasonable, I think, for that kind of, high quality business that, won't get disrupted by AI, long growth runway, led by a great management team, profitable, all that stuff. So it fits all my criteria. I still think it's a buy around the current prices.
Interesting. I will say this one is very interesting. Let's maybe move on to another one. A colleague suggested Zedcor. So ticker is ZDC. This company focuses on technology-based security, a market cap of around $600 million. What do you think about this one?
So Zedcor is the kind of opportunities that I like to find early. And I don't think we are early now, at 600 million market cap. But I used to own this company when it was, I think, a $50 million company a few years ago. And unfortunately, this one I sold way too early. So I don't own it today. But it's the kind of opportunity where, like D-Box, you have a long growth runway in front of the company. It's led by a great management team. They have a proprietary product and they've been executing exceptionally well. It's been, they've been growing very quickly almost every quarter, every year since the last several years. So, I think very highly of the management team. Great business. Valuation, I think, is getting a bit expensive these days. I haven't looked at the multiple recently, but I'm pretty sure it trades at 25 times or more free cash flow multiple. So, but it depends even how you look at free cash flows, because they're reinvesting so much in their growth and building these new towers that they actually don't generate free cash flows today. But if you if you did a pro forma of like steady state, they stop growing, what's the free cash flow profile? I still think it's expensive. Okay. So that's valuation would be the main reason why I stay on the sidelines on this one at this point.
I know the company has pulled back a little bit from around $7 to just over $5, but in terms of the valuation for a company that's investing quite heavily into the business, do you ever go to look at, let's say, price to sales at all for companies like this?
For technology companies, like software as a service companies, for example, yes, typically I value these companies on sales multiples. But for a business like Zedcor, not really. Because, if you look at technology, the margin profile is pretty similar from company to company. You're talking about maybe gross margins between 70 to 90%. The operating expense profile is fairly consistent across businesses as well. So you can, when you look at a sales multiple, this is just a proxy for what you extrapolate what the cost structure will look like in the future and what kind of profitability they will be able to generate in the future. Most SaaS businesses can generate profit margins of 20 to 30%, some more, but that's why you look at it on a sales multiple initially when it's not profitable, because they'll scale into profitability over time. But if you look at a company like Zedcor or, Kraken or D-Box, they all have different margin profiles. So you can't extrapolate and compare. The sales multiple on one is not equal to the sales multiple on another business. Okay. That's completely different.
At the Toronto MicroCap conference in October of 2025, one of the interesting stock pitches I heard was this next one. Firan Technology Group, FTG.TO. It's a 530 million market cap company, and it seems like they focus on developing and designing solutions for the defense and aerospace sectors. At the time the stock was presented, I think the price was around $10 a share. And the only reason I didn't invest in it was I felt like I had too many stocks in my portfolio and I didn't want the portfolio to get cluttered. And then it ran up to around $26, has since pulled back to $21. But I would love to know what you think about this company, the investment thesis around it. And then we can pick away at a few things.
For sure. So this one, it's been on my radar for a while as well. And, I even visited them in person last year. So I visited 2 of their facilities. I spoke with the management team a few times. And, I think it's a decent quality business. It's a great management team. I've been very impressed with the CEO. He's a long-term thinker, good capital allocator. They've made some very smart acquisitions over the years. So it's a very well-managed business. That said, historically, it's been cyclical. They're tied to aerospace and defense. Both of those end markets are cyclical. But today, both cycles are going in the perfect direction for Firan, because if you look at the backlogs of Boeing and Airbus, it's at, I'm not sure if it's all-time high or multi-decade high at least. So the tailwinds for the aerospace industry are very strong for the next 5 to 10 years. And then defense right now is the hot topic. All the defense spending right now is very elevated. So I think investors got carried away a little bit with all this short to medium term momentum. But if you look at historical multiples for Firan, it's been trading between, call it 6 to 10 times EBITDA for most of its existence. And suddenly today, people value it at 25 times EBITDA. But it's still a cyclical business and the cycle will turn at some point. So the way I view it right now, I think it's risky to buy at these levels. So again, like Zedcor, I can say there's nothing negative I can say about the business or the management team. It's just valuation for me is not attractive right now.
You mentioned a multiple of EBITDA. I assume enterprise value to EBITDA. Why the focus on this metric for Firan as opposed to some of the other metrics that we've discussed? And this question is more for education for me and my listeners.
Yeah, well, it's like I'm using EBITDA because that's what the analyst community uses. So there are multiple analysts that cover the stock and they all use EBITDA. So that's the shortcut for me. But in my own model, back when I looked at the company and valued it for my own purposes, let's call it a year or 2 ago, it was again more of a free cash flow multiple. And I don't have the up-to-date data as of today.
In terms of revenue generation, do they focus a lot on long-term contracts?
I think so, yeah. Because, in aerospace and even probably in defense, if you get spec'd in for a specific, you sell a cockpit assembly for this type of plane, and the plane is going to get produced for the foreseeable future, like 5-10 years, maybe even more. It's very hard for the airline OEMs, the aircraft OEMs to switch products in and out, because there are some very stringent qualifications for these types of equipment. So Yeah, for the most part, the revenues are pretty sticky.
Okay. Why don't we pivot to commodities? This is not a space that I invest heavily in, but it's getting a lot of attention, especially in the last year or so. Are we okay to talk about Lotus Creek exploration?
I can talk about it. I'm not an expert on it, so I can give you my very high level view. But
a colleague submitted this one to me. So ticker is LTC. They focus on exploration, development, and production of crude oil and natural gas in Western Canada. Market cap of around $140 million. I only have a few basic questions on this, but would love your thoughts.
Yeah, well, I started looking more at the oil and gas space early, but let's say starting middle of last year, and I started investing a little bit in some microcap producers earlier this year, before the war started, actually. So I've been, learning about the space. Like I said, by no means am I an expert on the oil sector, but Lotus Creek, from what I've seen so far, it's, they have some of the better growth opportunities that I've seen in the microcap space. If you look at the small producers right now, most of them are focused on capital allocation. They're buying back stock. They're paying dividends. They're keeping their production more or less flat, or maybe they're growing like 5% a year. Lotus Creek has been investing to develop new wells and increase its production, and it's increased its production quite a bit over the last couple of years, and they have some solid growth aspirations going into the next 12 months as well. So if you're looking for a growth oil producer, I think this one looks attractive. But that said, it's like the space right now is very fluid. If you follow the recent news, apparently the war is over, and the oil price has crashed recently. So what are the economics of those new wells that they're bringing online at this lower oil price? I'm not sure, and it's something I would assess before investing.
My understanding is for this company, it's crude and natural gas, but natural gas is a much smaller component. Is that correct?
Yeah, I believe it's mostly oil weighted, from what I recall.
Okay, let's take a look. I think this one you know pretty well. BQE Water, ticker BQE. And this one was interesting because they specialize in water treatment and management for the mining industry. I would love your thoughts on this, whether you still view this as an appealing investment. My only concern about it is I wonder, what if the price of gold corrects? I know there's a lot of people who believe that gold still has a long way to run. I'm not an expert in gold, but if it does correct, although there maybe are a lot of mines in operation now and maybe more to come with the high price of gold, what if that trend reverses? What does this mean for BQE? These are some of the things that I'm thinking about and would love your take.
Yeah, well, actually, you know what? I'm going to flip the question around. If you look at the last 5-6 years, let's say before the big run up in the gold price, it was actually a very depressed environment for metal prices in general. It was a very low capex environment. Not a lot of mines were coming online. The producers or the exploration companies weren't spending a lot on developing new projects. And if you look at the BQE track record, they grew their revenues by, I think it was over 30% compound annual growth rate during that depressed period.
Wow. Okay.
And they grew their profits also at, I don't recall the exact number, but let's say 15-20% per year as well. So now they are entering a period where they have tailwinds in their business because, it's a very long cycle. Like if you want to bring a new mine online, it's a very long process. Multiple years. You have to do all the pre-feasibility study, feasibility study, environmental studies, all that stuff. You have to develop the project, the engineering, the construction, then you bring it online. So BQE tends to get involved very early on when the company the producer is doing all these studies of how they will handle the water treatment at the site when the mine is online 5 years later. So BQE will provide all these technical services up front, and then eventually when the mine becomes producing, they can treat the water. They can provide the services to treat the water, to operate the water treatment plant for the life of the mine. Okay. And these contracts can be, upwards of 20 years in some cases.
Okay.
So it's a very, very long process. And right now, what we've seen the last, year, 12 to 18 months, the mining companies have been raising a lot of capital and now they're going to spend it. So I think BQE will gain new business for the foreseeable future. And as these projects come online, they're going to land new operations contract as well for the long term. So I think this one has very, very strong tailwinds for the next 5-10 years.
Okay, so you sound fairly bullish on this one. And
I am.
The way you described it, this is not just a switch that gets flipped on or off. And clearly myself, as a physician, maybe this is just a lesson to some listeners. Maybe invest in what you know. I'm not an expert in this space, but
well, you know what? I'm not an expert. I'm not an expert either. I've never really invested in the mining sector before. But again, it's like I just look at the track record. If they were able to be successful in a very depressed environment, what can they do in a mildly favorable environment or even a great environment? I think it's probably going to be better than the last 5 years.
Yeah, it's corrected a little bit right now. I think from a price of 87 to 68, such that the free cash flow yield on this company, I believe, is approaching around 4.5%. If I'm correct, how does that compare to its historical norms?
I couldn't tell you the comparison to historical norms, but the main reason why the stock pulled back recently is because this business is seasonal. They treat water, so some mines in the winter, water is frozen. There is no water treatment required. So their Q1 tends to be the weakest quarter of the year from a seasonal perspective. And so if you're going to look at this business, you have to take that into consideration. Okay. So I recommend people look at it on a trailing 12-month or yearly basis. And like the last quarter was just very weak. And the next few quarters should be much, much stronger. So I look at it more on a next 12-month basis on my end, and the valuation is still very reasonable.
And is it fair to say they had a pretty tough comparable to Q1 2025 due to a few specific projects that they were involved with?
Yeah, exactly. So there's seasonality, but there's also, the technical services projects they work on. Some are big, some are small, some, get delayed, slip into the next quarter. There are some moving pieces. So that's why it's very challenging to look at this business on a quarterly basis. Gotcha. And I wouldn't recommend people do that.
All right, let's wrap up with a few healthcare stocks. First one is Medicure. MPH. Now we're getting really, really small. I believe a market cap of around 10 million, a pharma company based in Winnipeg. And I think part of their revenue stream focuses on products that go direct to consumer. So bypassing the pharmacies, which is interesting. Any thoughts on the company, the investment thesis around this one?
Well, yes. I mean, I'm going to keep it fairly simple in the sense that it's a company that I've been following for probably 10 years.
Wow.
And I'm still waiting for the inflection point.
Okay.
Because it's not profitable, and it hasn't been profitable for many, many, many years. And so it's the kind of business where I keep it on my radar. I look at all the financial statements, all the press releases I've been following for a long time, but they can't seem to turn profitable on like sustainably profitable. So this one is on the watch list, and if fundamentals improve at some point, I'm gonna probably ramp up my research a little bit more, maybe get in touch with management again, because it's been several years.
Okay.
So I can't give you a very accurate picture of the situation other than it's too early for me.
No problem. Last one, Matthew, I believe a company you know well, KITS Eyecare, ticker KITS, around a 400 million market cap, focusing on online retailing in the eye care space. I have some questions around competition in this space. For a long time, I have been buying contact lenses online through a company called Clearly, and they've been wonderful. They'll send my contacts to my doorstep in about 3 or 4 days, and would love to know about the investment thesis around KITS, total addressable market, competition, valuation. Would love to know more about this one.
Yeah, so KITS, I mean, if we start with total addressable market, obviously eye care is a huge category, like multi-billion-dollar category in North America. the way KITS approached the opportunity initially, because in eye care you have contact lenses and you have glasses, and most of the margins, or at least the better margins, are on eyeglasses. And that when you go to the optometrist and they sell you a pair of prescription glasses for $500 or $1,000. I mean, the margins on this are truly amazing. But these companies, they need to charge such high prices because they have to support all the infrastructure of the store and the employees, and there's brick and mortar infrastructure that's behind that. KITS, they said, okay, we're gonna go fully online, only digital experience. We're gonna avoid all the brick and mortar costs, so we're gonna be able to offer these products at much cheaper prices. And also, they decided to build their optical lab in Vancouver.
Okay.
So they are vertically integrated. Instead of outsourcing the lens manufacturing to a third party that will keep a margin, they do it in-house. So they can offer disruptive prices in the marketplace. So you can get a pair of prescription glasses for $58 on KITS.ca.
Wow, that's it? Really? Okay.
Yeah, single vision.
Wow.
And then you have upgrades. Like if you want progressive lenses, you pay more, but it's truly like much cheaper than the competition. So the way they approach this, they started with the contact lens business initially. They bought a company that was selling contact lenses online. They already had, I think it was 40 million in revenue. So they bought this asset to get an initial revenue base and customer base that they could upsell the glasses to over time. So now they're like, the last few years, the strategy has been, yes, we want to grow the contact lenses business because it's a good, stable, recurring business. But then we want to upsell these customers to the higher margin glasses offering as well. So the story is, companies growing 20 to 30% a year, profitable. They're not optimizing for profitability right now. They're spending a lot in sales and marketing to grow faster. So this is one example where I think it's appropriate to value it on a sales multiple, not an EBITDA or a net income multiple. And the assumption I'm making here is, at scale, I think they will be able to grow their gross margins to upwards of 40%, and their profit margin from the current, low single digits to about 15%. I'm talking over the next few years. And at that point, if you have a 15% profit margin, you value it at 15 times earnings. That's a 2.25 times revenue multiple. So at scale, in a few years, I think between 2 and 2.5 times revenue is kind of a fair value range. And right now, they're trading a little bit below 2 times revenue. So, I think you're buying a company that's able to grow upwards of 20% a year, and you're buying it below its fair value multiple. So that should be, if my thesis plays out according to what I think is going to happen, it should be a good investment from here.
Based on your knowledge, are you concerned about competition on the horizon?
I mean, it's a competitive industry for sure, but like the brick and mortar stores are so profitable that there is a lot of margin buffer to go after into this industry. So I think, KITS can carve out its piece of the market share in that industry fairly easily by offering lower prices. I mean, some people will keep buying in store, like habits don't change right away. So it's going to be a long process. There are also some online competitors that do similar to KITS, but most of them, they manufacture overseas. So the biggest one in the US is called Zenny. They manufacture in China, which could be a problem these days with Trump's tariff agenda and all that stuff. Yeah. So being a North American based manufacturer, I think is a nice place to be right now.
Okay, Mathieu, as we wrap up, we just discussed 7 stock names, and I think for many individual DIY investors, it can be tempting to try and pick out a few favorites and focus on those. However, I suspect that in your portfolio, you have between 15 and 20 holdings. And I suspect over time, correct me if I'm wrong, but the majority of your gains have probably come from a few winners that have really driven returns. So maybe talk to us about how should one think about investing in microcaps? Because to me, for a DIY investor to pick out a couple names, that might not be the best idea. It might be best to spread things out a bit, but some guidance here is appreciated.
Actually, I think it's the opposite. I think
you think
if
so?
You are, if you are part-time, you should concentrate even more. Because
really?
Because the challenge, I mean, it depends on your approach, but for me, like my edge, I think, is knowing the companies I invest in better than most people. So I do a lot of fundamental research. I go deep, when I look at a new idea. And if I only have, a few hours a week to spend on investing, I need to, focus on a handful of names that I think are, the best opportunities right now. And if I own them in my portfolio, I want my maintenance due diligence as well. Like you have to spend time just to keep up to date with your existing position. So if you own 15, 20, 30 names, but you only have a few hours a week to spend on them, I think it's going to be hard to succeed. So yes, you're more diversified, but I don't think you can outperform that way.
Yeah. Is there anyone who should not be investing in microcaps? These are going to be more volatile by nature, but is there anyone who maybe this isn't a good fit for?
Well, just to go back, if you don't want to spend the time, do the work, I think it's a very tough place to invest because the market is not efficient. Like if you buy large caps, you can assume that the market is somewhat efficient. These companies are well researched and they're probably relatively fairly priced. But in microcaps, things can be mispriced. There can be a lot of risks that are not well known. There's no one will spoon feed you the research, So you have to do the work yourself. If you're not comfortable with volatility, if you can't control your emotions, to go back to poker, if you can't handle the volatility and you're going to make the wrong decisions at the wrong time because you're going to get carried away by your emotions and sell when it's not the time or buy when the stock has run up because you're excited, that won't work. So you need to keep a cool head, do the work, rely on the fundamentals. And that's...
You've obviously learned so much and you've shared a lot on your processes. Are there any resources or books that really just blew your mind that you would recommend to people who want to deepen their investing knowledge?
Well, that's a tough question because there are a lot. I'm a big self-learner, so I've read, dozens of investing books. I would say,
any favorites?
In my early years, I would recommend Howard Marks has written a couple of books on investing, and it's more about the psychology of investing. Because he's a fixed income investor, so you won't learn how to pick stocks with that book, but you're gonna learn about the market psychology, the cycles, how to manage your emotions, how to be, when you should be more aggressive or more careful. And I think this can be very helpful when you invest in microcaps. So there are a lot of lessons.
Is that Mastering the Market Cycle, his book?
Yes, that's one of the two books. The other is The Most Important Thing.
Oh yeah, haven't read that one yet. Okay. And Mathieu, I just want to give you a chance now to share with people, where can they learn more about you, your fund, the work you're doing?
Yes, sure. So for the fund, it's called Rivemont Microcap Fund. You can visit our website, Rivemont.ca, Rivemont. So you have all the information on the fund there. And I also write a personal newsletter. So it's not affiliated to Rivemont, but I write actually about some of the companies that we own in the fund. It's called Stocks and Stones on Substack. So I publish a couple of blog posts per month. And the other thing is you can follow me on social media. I'm active on LinkedIn and Twitter or X. So I post a lot of content regularly there as well.
Mathieu, I just want to thank you for being so generous with your time and explaining a topic that a lot of us aren't deeply familiar with in a really digestible way. I really appreciate it. I think the listeners will too. And it's been wonderful to connect with you.
Sounds great. I appreciate the invite. Thanks a lot for having me.
My pleasure. All right, that's a wrap for today. I hope you enjoyed that one as much as I did. If you're getting value from Beyond MD, I'd be grateful if you could consider sharing the podcast with one person in your network. Until next time, we'll see you in 2 weeks. Stay well, Stay savvy.